Talking about the week that was, as we like to do here at the beginning part of the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, Joel Garris, certified financial planner and certified financial fiduciary at Nelson Financial Planning, where we got a team of good folks that happen to also be certified financial fiduciaries as well that stand ready to help you improve your life with a successful and cost-effective financial plan. So, can't start the program without a conversation of what went on this past week, particularly on the banking side. Certainly, it seems like the banks, if you will, that were involved in creating a lot of the headlines weren't particularly well run, particularly if you kind of look at how they were making their investments and, more importantly, how they were valuing their investments in their banking portfolio. There is a difference when you value something at current value, which means this is how much money I can get from it today, versus maturity value, right? So that's how much it's going to be if I can hold it to maturity. But the notion of assuming that you can hold it to maturity can, in fact, be a poor assumption, as it certainly was for the folks at Silicon Valley Bank, because then they were forced to start to sell, and when they're selling at a loss. As a customer, if you're above the $250,000 FDIC limit, those are the kinds of things that you should probably investigate with the bank. The bank's going to have a public document, it's going to have a public filing with the SEC. So look at that. What percent of your bank's investment portfolio are they valuing at maturity? Because in today's world, most banking portfolios are generally hold treasuries. So with treasuries, though, as interest rates have shot up over the past 12 months, the current value of those treasuries is down. Maybe not if you hold it all the way to maturity, you're going to get the face amount. But if you have to sell it today, you're going to get less than the face amount. Silicon Valley's example, it was over 90% of the holdings in their portfolio, they were presenting the value at maturity. So it's a very simple look-see at the bank that you're dealing with. Just go to the SEC website and you can see, oh, wait a minute. This bank had a lot of stuff that it wasn't accurately reporting what the current value was. So it seemed to me that that's a pretty easy way to do that. And I guess that's one of the things that kind of troubles me a little bit is how quickly the FDIC rode in and sort of rewarded the customers of Silicon Valley Bank in particular to almost encourage that kind of behavior, because as a customer, if you've got, millions of dollars and you're well above the FDIC limit, and certainly there's a lot of businesses that would be in that position, particularly if you're a startup of maybe you got a round of venture capital financing, you got $10 million sitting in the bank somewhere, you might probably want to do some investigation on kind of what the story is. So banks are businesses, folks, just like anything else. And you've got to do your diligence on who you should bank with. And that's certainly the case. But Fed rode to the rescue and backstopped everything. So I guess the FDIC limit isn't 250 anymore. It's whatever you got, we'll cover it. At some point, rest assured that those costs will reverberate back to you and me. Don't believe that there's not going to be ever any cost to you, the general public, because banks will find a way, just like any other business. It's not necessarily a dig at banks, but let's remember, banks are businesses. They're not like altruistic little charities. They're for-profit institutions. So do your homework. As we say constantly on this program, do your homework, do your research. So that was the beginning of the week. As the week progressed, started to actually get some interesting economic data. And that's really what we want to talk about here in this segment. So inflation reading, right, dropped to 6% from 6.4 down to 6%. Spending dropped a little bit, down 0.4%. Those were kind of the headlines on Tuesday, Wednesday. Thursday's headlines had to deal with weekly jobless claims. So if you think about the economic data that actually came out this week, well, that should strike you as, hey, isn't that trending in the right direction based upon what the Federal Reserve is currently trying to achieve? And maybe, coupled with the backstory of these banks, that could set the course for the Federal Reserve to maybe slow down and pause and see how all of this plays out. And so that would be something that over time, I think the economy and the markets would certainly applaud. So I think that's the other piece of this story, that yes, you had the banking story happening, but when you look at some of the economic data, it seemed to be trending in the direction of what the Federal Reserve was ultimately trying to do. So the reality is, the bottom line, if you will, for the week is that certainly banks are businesses. And banks can be run by people that make bad business decisions or choose to not represent the full, accurate picture of what's going on with their finances. Enter the SEC and the DOJ investigating and stuff like that. Banks are not immune to that. So do your homework, do your research, particularly if you've got assets at any particular bank that are above $250,000. It's important to do that exercise and look specifically at how much of that bank's investment portfolio is represented on its books as current value versus at maturity, because therein lies the problem. Because with the run-up in interest rates, it has driven down the price of treasuries. So that means that if you had to sell it today, you're going to get less money than what it's worth, a la Silicon Valley Bank and the problems that it had. Number two, I guess the comment also that we would make is that, Fed to the rescue. They didn't waste any time in backstopping the folks out in Silicon Valley. So I guess by extension, if they backstop the venture capitalists out in Silicon Valley, if this were to extend to any other bank, I would hope that they would then backstop, mom and pop businesses, right? I mean, so Fed to the rescue. Okay, there you go. And then let's not forget the economic data. The economic data, certainly, as you look at this past week, seems to be trending in the right direction, as it has been, seeing inflation kind of get pulled down on a pretty regular basis over the course of the past 6 months. And that's ultimately what the Fed is looking at to try and reduce or maybe lessen rate hikes. So that's the recap of the week that was. Let's shift gears to the budget proposal, which came out the week prior. Overall budget costs a mere $6.9 trillion. So, that's not an insignificant amount of money. An increase of roughly 10% over the current $6.4 trillion that the federal government is expected to spend in the year 2023. So obviously a budget document that is put up by the executive branch, right? I mean, it's the legislative branch that kind of, controls the purse strings. Executive branch puts out the budget. Obviously, that is sort of an opening conversation. Hopefully, it's a part of an opening dialogue, but, not sure politicians can have that these days, but that's a different story. Certainly a statement of kind of priorities and those kinds of things. So we thought it would be good to kind of hit some of those, particularly obviously on the tax side of things. Here we are kind of in the middle of tax season, roughly about 30 odd days to go until the tax filing deadline. So some of the proposals in the budget, as you might well imagine, expand taxes that go towards Medicare, right? So instead of the existing 3.8 on wages and self-employment income and things like that, that applies above, an additional 3.8 that applies above income earners above 400,000. The notion would be to raise that up to 5%. So that's one of the pieces. There's a whole lot of others, starting with, you guessed it, extra funding for the IRS. Wow, that's fantastic. I'm telling you, those darn cheating Americans, we gotta do something about them. We're going to talk more about that, though, when we come back here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Those darn cheating Americans. That's the only conclusion, or one of the many conclusions that you can draw as you parse through the current budget proposal coming out of the executive branch last week, or the week before last, should I say. We'll talk about all of that here on the program, because one of the provisions is to expand the budget of the IRS by 15%. Now, that's on top of the separate $80 billion in extra money it got last year. I'm sorry, okay? What do we do at the office? We probably process 600 tax returns in a given season. Let me tell you something. The average American is not cheating. First of all, they really can't, because the vast majority of tax documents that you get are copied to the IRS, right? Your W-2s, your 1099s, all of that, the IRS gets a copy. So they kind of know the story already. So this suggestion that, man, if we could just figure out a way to get Americans to stop cheating on their taxes, boy, we could solve this budget thing, no problem at all, is a load of you-know-what. Average American is not a tax cheat. The reality is that they're paying their taxes, they're paying their way, and most of the documentation's getting copied to the IRS. But the IRS got $80 billion last year, going to get an extra 15% based upon the current budget. Now, here's the reality of what you need to know about this. Current budget, of course, is just a proposal, right? Sort of, as we said in the last segment, a starting off point that many of these will hopefully not see the light of day. But it's certainly, I think, an important part of the conversation as you think about the future, because the reality is that there are certain things that are on the table, and maybe they don't come to fruition this year or next, but the fact is that we've certainly seen tax policy evolve over the years. And some of the concepts that you would look at 20 years ago and say, that's never going to happen, the reality is that it does. And so it's important to kind of keep all of these in mind as you're thinking about your finances and how that might play out. So we're going to get into some of the specifics in terms of tax changes and tax increases that are included in the budget, because ultimately you've got sort of competing interests, if you will. It certainly is a higher amount of projected spending. As we said, $6.9 trillion versus the $6.4 trillion that is expected to be spent this year. So in 1 year, that's like a 10% increase. And you contrast that with this notion of we're only going to make a very small group of Americans, those top earners, we're going to make those guys pay for what is basically a 10% increase in the entire federal budget. Those are certainly competing interests, because the math is not there. As we said on the program last week, the top 5% of earners in America pay almost 2/3 of all federal tax receipts to the government. So if that's the case, like, how much more are you going to get out of them to close these massive budget gaps? Anyway, be that as it may, here are some of the suggestions. And it fundamentally looks at higher taxes on wage income, higher taxes on investment income, and ultimately higher business taxes. That's sort of where all of these types of tax increase are kind of focused on. So the first one would raise the marginal tax bracket up to 39.6%. That was where it was in 2017 before some of those tax cuts. The reality is that it would take the 37 and kick it up to 39.6, effective immediately, rather than waiting until 2025 when all of those tax cuts that happened in 2017 ultimately sort of sunset. So it would do that and would do that effective immediately. What it would also do is increase the corporate tax rate. 2017 tax cuts, the corporate income tax rate was 35%, which was actually the highest tax rate in the developed world. Cut that down to 21. This proposal would raise it back up to 28%, bringing the U.S. back towards the top, if you will, of what the worldwide average is for corporate taxes. So income tax rates, obviously that's getting targeted to have that change to that 39.6 number occur prior to when it is going to naturally occur, which is in the year 2025. Also, corporate income tax rate going up from 21 up to 28. Similarly, with long-term capital gains and dividends, which have long enjoyed sort of a preferential tax treatment under the tax code. Long-term capital gains currently topped at 20% plus an extra 3.8% tax that is the net investment tax. So your top capital gain rate is like 23.8. The proposal would raise that for incomes over $1 million, would raise that to be taxed as ordinary income. So that would be the 39.6 plus the net investment income tax as well, which is the next thing up. They want to raise that from 3.8 up to 5%. That applies to passive income, investment income, capital gains, dividends, things like that. So ultimately then capital gain, if income's over $1 million, capital gain would go from basically 23.8 to basically 44.6%. That's a pretty significant jump. Now you may say, well, I'm not going to have income over $1 million. Here's where it matters, and where we see it matter more often is that on a particular sort of transaction. So let's say you sell your business, or you sell your stock of your company employer, and that boosts your income for that year above those numbers. The reality is then that, instead of paying 23.8, you could potentially be paying 44.6. And again, back to the sort of the theme or the concept as you think about these and hear these aren't for sure, ever going to see the light of day. And certainly some of these are just repeats of some of the tax changes that were proposed over the course of the past 2 or 3 years when it wasn't a divided Congress, when it was a more kind of Democrat Congress, and they didn't pass in that situation. So I don't know that many of these will ever see the light of day, but I think it's important to think about where might these things go? And certainly when you think about that net investment income tax, which was a newbie that was sort of thrown in, and now they look at it as, oh, well, we can just shift the rate up on that, and that's going to ultimately raise additional income, combined with the fact that the capital gains rate, there seems to be some chafing on that being a lower or preferential tax rate. So obviously, stay tuned on that. Similarly, the stock buyback tax, another one that just started with the inflation, the oddly named Inflation Reduction Act that passed last summer, established a new tax, a 1% excise tax on the total value of stock repurchases or stock buybacks. Now they want to just take that 1% and make it 4%. Why not? Once it's on the books, folks, that's the problem, right? Once it's on the books, then it's easy to just run up the amount of the number on it. So stock buybacks, they want to basically quadruple that. So you can argue back and forth as to who benefits on stock buybacks, but it's hard to say that that's not in sort of the investor's best interest, because when a company does a stock buyback, it means that there's less shares outstanding. So as the value of that business goes up, well then, if there's less shares outstanding, then more of that gets reflected in the appreciation of those shares that are still outstanding. Another one, and this is one that's floating around, and that is to end the step up in basis at death. And this one is pretty significant because that notion of eliminating the step up in basis actually gets to taxing appreciation that has occurred in an investment that was never sold, and then someone dies and now you've got to pay the taxes. So we're going to talk a little bit more about that one when we come back from the break. So stay tuned with us through the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the latest tax proposals in the Biden budget that was announced about a week or so ago. We've talked about a number of them. We're talking about the suggestion of the elimination of cost or the step up in basis. So let's just recap a little bit of what that concept is. So let's say that there is a piece of property or a stock that your parents owned, and they owned it for a gazillion years. And when they first bought it, it was like $10,000. And okay, now it's grown and it's like $500,000. So what happens today is that when they die, the basis for tax purposes jumps up to the value at the time that they pass. So it jumps up. The 10,000 would effectively jump up to the 500,000, which means that there was $490,000 of gain that was never taxed. So you get the idea pretty quick, is that there was gain, there was profit, and it was never taxed. So obviously the notion of eliminating that step up in basis at death seems like a pretty attractive kind of proposition in terms of, hey, that's some profit that we could tax, and then that would help to generate additional revenue into the U.S. government. So certainly that one has been bandied about for a little while. It would not surprise me if some form of that ultimately sees the light. So what does that mean for you as an investor? Well, at the end of the day, it's probably something that you need to start to think about a little bit more in terms of, what do I do if I have a highly appreciated asset? Is there some way that I might gift some of it now, or decide to do something with some of that profit along the way? Now, particularly if you think to the conversation of what we're having about where the capital gains rates might go, yeah, you may want to just pay some capital gains rate at today's rates rather than the big question mark of how much higher those might go. So ending the step up in basis obviously would be relatively significant. And then, of course, the one that made kind of more of the headlines this past week, creating the billionaire minimum tax. So it would basically be a new minimum tax on 25% of income and unrealized, and there's one of those concepts that we're going to have to talk about, unrealized capital gains for the wealthiest 0.01%. Those with more than $100 million in total wealth would then have to pay this. And so this, first of all, this new minimum tax, if you will, would be yet a third parallel tax system that would exist within our tax code. So there's the regular income tax system, there's the alternative minimum tax system, and then there would be this third, kind of billionaire, millionaire type of tax system. So again, once you introduce this stuff and get it on the books, then it's easy to kind of run up the numbers to make it ensnare more people or cost even more. So the real concept is this notion of unrealized capital gains. And it kind of goes hand in hand with the conversation we just had about the step up in basis and eliminating that. But the notion of taxing unrealized gains is, I think, a pretty tricky one, because if you've owned shares in a company, or if you have a piece of real estate or a business, shares in a company are easy to evaluate, but how do you evaluate real estate every year, or the value of your company every year? Those are all unrealized gains because you haven't sold them. When you sell them, then you know exactly how much they were worth when you sold them, because you have a price tag on that. When you don't, then my goodness, how are you going to come up with the numbers and the valuations that are necessary to do that? Combined with the fact that it just sort of flies in the face of sort of one of the fundamentals of the U.S. tax code, which that if something has not been realized, if you haven't sold something, then the profit in there has not yet been realized. And so there's nothing to be taxed on that until such time as you realize or convert that asset to actual dollars. So certainly some interesting proposals, many of which, as we said, will never see the light, but I think it's important to remember them as investors and thinking about what your particular financial situation may be, particularly if you are involved in a situation where there's sort of a big payday. Maybe you own your own company, own your own business, or maybe you've got like ESOP through your employer. Those types of situations, or maybe you have a lot of land. Those types of situations could certainly trigger a little bit higher and different tax orientation from what you would typically suspect. So certainly some important things to remember on that. So we will shift some gears on this. I'm trying to decide. We probably don't have enough time to hit that one. But let me hit this one in terms of some interesting data or some interesting stats that we saw on the latest technological innovation. And it really has to deal with the pace of adoption. And this is one of those things that really is just increasing at just dramatic rates. When you think about adoption of the television or radio or those types of things early on, it took like decades before, it penetrated society to the extent that those technologies did. Well, fast forward to today, and some of this technological stuff is just absolutely going at light speed, and the latest of which is sort of this artificial intelligence conversation that is everybody is sort of chatting a little bit about, and that's this Chat GPT or OpenAI, and what that is you can just ask a question and then it will pose back to you a sort of a structured sentences or paragraphs or things like that that is the response to the question that you asked. Matter of fact, Buddy and I were fooling around with that this past weekend, and it is interesting. Like, write a nice note to my wife on her birthday, and then it would spit out 2 or 3 lines. It actually pretty nice. So that's kind of how that works. Or you could say, write a speech that I need to give to a group of clients about the economy, and poof, okay, out would come a variety of paragraphs that would give you your speech. So it is kind of fascinating technology. What's even more fascinating is again, sort of underscoring the pace of adoption. ChatGPT reached 1 million users in basically 5 days. It's just unbelievable. Even if you think about like Netflix, it took them 3.5 years. Netflix wasn't it's not it's a concept that's relatively new. It took them 3.5 years to reach 1 million subscribers. Airbnb, Kickstarter took them 2.5 years before they reached 1 million users. Facebook took them 10 months. Instagram took them 2.5 months. ChatGPT took them 5 days. The pace of innovation still continues. The pace of technology still continues. And as an investor, that's why you want to own companies, because there are a lot of companies out there that are making great products and inventing things that are sweeping this country on a regular basis. With that, we'll wrap it on up and get on out of here. That's about it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more, give us a call at the office at 407-629-6477 or visit our website, nelsonfinancialplanning.com.